you've got a double top up there at 35. I say top, meaning a flat structure. You go back to 35 a third time, you're going to have a triple top breakout. Silver does not top with double tops, much less triple tops. When you get back to 35, that's when I think silver is going to get electric. So that was a statement as well. Well, gold knows this. And that's why gold's done what it's done, especially for the last year or so, since March of 2024, when it came up through 2000 for the fourth time. And now we have a sharp pullback in gold. We understand that I don't pay too much attention to internet chatter, but a lot of analysts on the internet have been saying, gold's got to collapse. It's overdone. This looks like 1980. This looks like 2011, et cetera, et cetera. And finally, they've been saying that for a couple of weeks, by the way. Finally, it did that. We had a very sharp drop in the last 48 hours. Now we're up today. And they no doubt think that was it. We were right. And we argue, no, you're not right. It is highly unlikely a top. That's just another teeth-shattering drop. And unlike most of you go back there to 20, where you go back here to 2024, 2020, yeah. Go back to 2024, yeah, right there. That's when gold came up through that 2000 price level again in early 2024. And we said, okay, the sleepy zone that gold had been in since 2020, namely in a basically horizontal zone, is over. We're going up. And it surged. But look at the layered, time-consuming congestion zones and corrections that occurred over the last year. This one, the last one we had, a couple of weeks ago, a month or so ago, was a very quick one, a huge red bar to the downside. Then we jolted back up. And now another jolt to the downside, but they tend to be quicker and over with quickly. And we don't think this was the top. There's a couple reasons for that. And we think that right now we're on the cusp, partly because of the gold pullback, but silver has pushed back up relative to gold in the last couple of days. If you'll notice, and this has got to be very confusing to silver folks, gold collapses in a 24, 48-hour period, and yet silver goes up each of those days. What the heck is going on? And I think what's going on is silver right now has been priced. You're going back there to May of last year, so almost a full year of, you could draw a line sideways on silver. And we've been either side of that $33 high that occurred in May of last year. So we're coming up to May of this year. So it's been 12 months and they've been selling it. And we've had a third sell-off. And this third one really looked real to most people. You went down and blew out the prior low that had occurred late last year. So you actually broke the what you might call an uptrend for the price folks. Look what happened after that. An immediate thunderbolt back up, not just a day or two, but persisting now into 3 weeks. And now we're back pressing up, trying to get to 34, for example. And we think even touching 34 is a big tell. You ever touch 35 again, and if you're a point and figure guy, X's and O's, right. $1 and $3 down, and you've got a double top up there at 35. I say top, meaning a flat structure. You go back to 35 a third time, you're going to have a triple top breakout. Silver does not top with double tops, much less triple tops. When you get back to 35, that's when I think silver is going to get electric, where you're going to suddenly get, on a macro basis, what we just saw the last 2 days, namely gold down, silver exploding. Now, I don't think gold is going to keep going down, by the way. But I think that what we just saw there was a shift in that spread to where silver is now back up to 1% of the price of gold, which in itself is historically very low. It's a bargain on a relative basis. And I think that's about to shift. I also think the gold miners are about to shift to outperform versus gold. And it won't take much there. Now, you don't, historically, if you go back and look at just the spreads, silver versus gold, gold miners versus gold, whenever they break out on a relative performance basis versus gold, that never means gold's going down and they're going up, or gold's going down and they're going down less. What it means is you're actually going to enter an accelerated phase in the price action in the markets. And I think that's what we're looking at right here. Yeah, there is a spread relationship when you divide the price of GDX into gold, where we are pressing this month at trying to achieve a breakout over about a 1-year downtrend on that spread. And I think we're going to get it. Now, you're looking there at what is that? That's you can see basically there's a structure overhead that you're trying to break. In other words, if that were a price chart, you'd say this looks like a bottoming situation. Yeah, go back to 2022. In fact, if you bought GDX, that low in the middle of the chart there, that there's 3 successive lows. The first, that one. Really, GDX is higher than it was then relative to gold. So since 2022, even though it doesn't feel like it, but since 2022 in the September period, if you'd have bought GDX, you're doing better than if you bought gold. You tell people that and they won't believe you, but it is on a spread basis. It's actually gone up more. But the question is, can you break out of that pattern of descending highs, which have now gotten sort of flat? And we think you're on the cusp of that. And when you do, I think you could get a gusher on the upside. Meaning a period of time over the span of a year, let's say, where the gold miners outperform gold 3-1.
Wow.
Specifically, we think that's what they could do. Same with silver. Yeah. So if gold goes up to, I keep throwing this number out. People sort of, but that's the target. No, it's not a target. But in the last 2 bull markets in the last 50 years, gold had 8-fold moves. Bear low to bull high, 8 times. Okay. 76 to 1980, 2001 to 2019, 2019. No, 2011, excuse me. So, different duration, but it was still an 8-fold bull move. Well, our bear low was 1,050. So if gold went to $8,000, people say, that's crazy. No, it's not. It's done it before twice, 8-fold moves. And we have an environment now, monetarily, asset class movements and so forth going on that's far greater than what went on in those times. So gold to go to 8,000 would merely be ho-hum. Well, if gold went to 8,000 and silver went to, let's say, 2% of the price of gold, which, by the way, silver's been 2% the price of gold in 21 of the last 50 years. So it's almost routine. Well, if silver were 2% the price of gold and gold were 8,000, silver would be $160. And in bull trends, silver relative to gold often goes to 3+%. It did in the 1980 move and it did in the 2011 move. Well, if you went to 3% and gold were at 8,000, you do the math. The point being that at this point in time, we think it's time to focus on silver and the miners relative to gold. That's a better place to be. For the last year plus, since late 2022, you could draw a line backward. And again, since late 2022, you're actually higher than you were then. And you can see how low this spread is. I mean, it's very low. And if you go back 50 years, that's exceptionally low. The last time we were at such a low relative level to gold, meaning under 1%, was back in early 2020. What happened then? Silver tripled in price.
Right.
And it doubled versus gold in terms of relative value. Now, we think silver could explode up out of this hole on a relative basis and a net price basis. There's another sharp move there in 2000, 2001 or so on the dollar index. And yet gold was making a bottom. It didn't go down. Well, the dollar went up. Now, when the dollar did go down then after a 2000 period and go down to the low in 2008, gold did rise. So there was a correlation there. But I think right now when that dollar breaks down, and it's already done price damage now, our breakage is 104 level. But even the price guys are upset because the lows in 2022 and 2023 were where? 100. Well, we broke that. So even the price charters are now scratching their heads. And they should, okay? Because I think we're headed down in a serious way. Now, look at the dollar index going back to the 2008-9 level on the top chart, where it made its low around 70. If you draw an uptrend through those lows, it's not broken yet, okay? If you try to draw an uptrend. But when you plot it on annual momentum, in other words, yeah, see that you're above the line still. Momentum is not. Momentum has blown that structure big time. So even though prices, they're attempting probably to buy near that line, momentum says, no, you're already broken. And I'm talking about 3-year average momentum and 10-year average momentum. Both have blown structures that go back that far. In fact, back to 2007. Yeah, I think that's assisting the stock market going down. And the foreigners, again, have been gut kicked 50%. If the S&P drops 20% off its high and there's a 10% drop in the dollar, it's far worse for them. And so naturally, if that's been a bubble of foreign money pouring into our market, then that exacerbates the deflation of that bubble. The only thing different this time that's is noteworthy is, you pointed out, the T-bonds aren't rallying while the stock market went down. They tried to, but then they got gut kicked huge from a price of 122 on T-bond futures to 111 in a heartbeat. And frankly, you better not go back down. We're now trading in the 114, 115 level on T-bonds, so several points off that recent low in price and below that high in yield. But if you go back to that low again, call it 111 and a half, let's say, watch out, the T-bonds could start to implode. And that is a far more fundamentally important factor to the central banks than what NVIDIA does. Okay. When you jeopardize debt markets, and by the way, on debt, I wouldn't just look at the U.S. government debt, which we all know is, at some point there's a crisis here. Everybody knows that the ratios are all off. Somehow it's got to be resolved. Well, maybe it doesn't get resolved. Maybe it ends up in a crisis. But look at other debt markets like commercial real estate. We're focused on that. Now, back in the 2007 period or 6, prior to the stock market collapse, it was the mortgage market, individual families. This time it's bigger stuff, commercial real estate. And there's 2 ETFs for that, RWR and VNQ. And they both are technically behave the same. They're broken like the S&P. They broke their quarterly momentum trends, and we think they're headed down. But that's already now. Look at that recent high. This is monthly. I can tell. You didn't go back to the 2022 high. S&P took it out. RWR is trading right now where it was back in 2007. Okay, either side of 100. It's pretty pathetic performance. Yeah. But you can believe that if you want. There's plenty of times that kind of stuff happens, and it's not. It's a price chart thing, and I don't think it's a bullish pattern. And also it's not the end of the month. Okay, but in the process of breaking this month, we blew quarterly momentum trend structures. The VNQ looks the same way, but the point is that this asset category you got to watch. Now, I'm not picking out specific events because we don't keep up with fundamentals. But I noticed that last week there was a failure of one of the biggest shopping centers in the U.S. I forget the name of the company. It doesn't matter. It was $300 million default on debt. Sorry, guys, $300 million. It's this kind of event in the commercial real estate arena, which could impact financial institutions. And so we're also closely watching the bank sector. Now, I know everybody's watching NVIDIA and Apple and so forth, but we're watching these financial sectors because we know that's the area, the arena, and T-bonds as well, that causes central banks to go absolutely berserk in terms of doing what they do, destroying the underlying real value of the money in it. That's, again, the motor under gold, although gold doesn't need a headline to go up. In fact, it rarely does. It goes up on its own. And the headlines come much later, and you say, oh, now I understand why. Okay. Anyway, this is an arena to watch here, is the commercial real estate.